Good evening, everyone, and welcome to Paytm Money Talk. And today's topic is the role of passive funds in an investment portfolio. My name is Neeraj Gogoi, your host for this talk today, and I'm sure you're excited. I'm also very excited about this particular topic because when it comes to passive investing, it's picked up lots of momentum of late. And today, to talk about it, we've got a very expert who is an authority in the field of passive investing. But before we start, I'd like to give you a quick introduction about what the Paytm Money Talk is all about. See, Paytm Money Talk is a platform where we basically bring new ideas, new strategies, new thoughts, new way of investing. And our endeavor is to consistently produce high quality content, which can really empower you in your investment journey. If you are someone who's looking for new ideas, new opportunities, this show is definitely for you. So before I start, again, invite our guest. I'd like to play a small film, and after that, straightway we are going to go for our discussions today. Shravan Kumar Goyal. He's a CFA charter holder, and he began his career in UTI AMC in 2006. And over decades, he was into risk management, equity research, portfolio analysis, and he is a kind of an authoritative figure in the world of passive fund investing. In fact, he has been managing lot many funds today, and of course, as we go ahead, we'll get to know more about him. So I'd like to invite Mr. Shravan Kumar. Mr. Shravan, welcome.
Thank you,
Great to see
Neeraj, for
you.
having me here.
Yes, great. It's
Great to
such a
see you
delight to
again.
talk to you all the time. In fact, last time
Thank
also,
you.
few last year, I think we discussed about the same, and it's great to see you here today.
Thank you, Neeraj. Thank you for inviting.
Yes, and Shravan, before we start, actually get into what the passive fund is all about, passive investing is all about, because you are a market expert, you have been dealing with market all the time. Like to ask you what the market looks like at this point of time. We have got beautiful result coming up yesterday on Friday, ICICI Bank and then Reliance. You know the earning season is on. So how do you think that the market is poised? Is it something going to be last year like 2022? Or we can see that we are getting breaking out of this kind of consolidation. So what do you think, Shravan?
Yep. Thank you. Neeraj, so I'll step back and talk about the issues that we are currently facing. So post-COVID, we have seen that uh, global markets to tackle the COVID pandemic, the most governments across the globe have resorted to fiscal expansion, which led
Exactly.
to spike in inflation, and to curtail the inflation, most central banks across the globe are resorting to expansion in interest rate. In the sense, they are increasing interest rate to tackle the inflationary pressure. While the problem of inflationary pressure in India is much more muted as compared to most developed markets, and that is the reason because, uh, in the sense, fiscal deficit is under control in India, while the same is not the case across the globe. We believe that currently markets are broadly pricing into global risk,
Hmm.
because Bloomberg consensus estimates that there are 65% probability of US heading into recession along with most European markets. But
Hmm.
typically, whatever news is in public forum, that is already priced in the market. So which means markets have corrected about 5 to 10% from the highs of October 2021, and there have been 18 months of time correction. So which means that markets which were trading at expensive territory 18 months back now has come back to fair valuation zone. So we are much better positioned currently as compared to 18 months back, because at that point in time equity markets were trading at +2 standard deviation. So if we can just open the slide wherein we have referred to slide number 2, wherein we have referred to market valuations. Right. So here you can see that currently markets are trading at 17.58 times 1 year forward earnings as compared to 10-year average valuations of 16 times. So which means
Mhm.
we are trading at fair valuation zones currently as compared to very expensive territory which we have witnessed 2 years back. And generally, investment in equity markets, when markets are trading at fair valuation at the same time when markets have gone nowhere in last few years, that is the best time to invest in equities. So uh, overall, we believe that currently we are in much better shape as compared to 18 months back. At the same time, the health of corporate balance sheets have improved drastically. So Nifty ROE, return on equity, has improved to 15% as compared to sub 10% level that we have witnessed during COVID period. So currently, we believe that the current levels are much more uh, balanced or much more tilted towards equity at this point in time as compared to what we have witnessed about a year back.
Wonderful. So you said market is fairly valued, and when the market is fairly valued, this is a good time to invest. So when it comes to investment, we have got multiple choices, right? We can directly go and buy equities, the stocks that we love or we like, or we can do it through mutual funds, right? And probably somebody who is new to the market, the mutual fund route is always preferable. It's always the first choice. Now, here comes a question like nowadays, when you talk about mutual fund, something emerging very fast, that is what is called passive funds. We knew about active funds, the fund manager used to buy and sell, choose the best stocks, and he used to produce lots of, return for us. And now we have got something called passive funds, and it is gaining lots of momentum. And you being the champion of passive funds, can you just tell us what the passive fund is all about? What is the reason that we should go and invest passive funds? Give us a little bit of good understanding into it.
Yes, Neeraj, we have seen phenomenal growth in passive funds AUM in last 5 years. We have seen that share of passives have increased from 4% of mutual fund industry to about 17% now in just
Wow.
about 5 years period. And at the
Hmm.
same time, size of passive funds have grown 10x from about 70-80,000 crore that we have witnessed 5 years back to close to 6.5 lakh crore. And world over also, generally, whenever markets are at nascent stage of development, at the time there are a lot of alpha generation ability for active managers. But whenever market starts maturing, the alpha generation ability of the active fund manager starts diminishing. So we believe that uh, the the developed countries have seen phenomenal growth in passive funds, and currently size of passive is bigger than active funds in US. And we believe that we are heading towards that particular trajectory. Probably it will take some more time, but we are also headed towards probably that phenomena. And generally, some of the advantages of passive funds is it uh, eliminates the human bias. So typically, active
Hmm.
fund managers react to market information, or they follow particular fund philosophy in a certain way which may or may not work in their favor all the time. So that's why we believe that first time investors who are new to equity markets, they can start investing with simple to understand nifty based index fund or ETF, because typically index funds replicate the broad market indices, and whenever you are investing in these index funds, you are actually generating returns which are closer to market returns. So once the new investors should start with passive funds because it's easier to understand, and these funds are available at low cost as well. So that's why we advise people to invest in or start investing in equity funds with simple to understand index funds.
Okay. So when you talk about passive funds, basically they are kind of an index-based fund, right? And one fund that you mentioned is our index Nifty-based funds. Is there any other indices as well where we can make passive fund investing if we apart from Nifty 50?
So there are various types of indices available in the market. So let me
Hmm.
broadly explain you the wide bouquet of products available on passive side.
Yeah.
So first of all, there are market cap based indices such as Nifty, Sensex, Nifty Next 50. These are the large cap based indices. So these
Correct.
indices are created based on size of the companies. So for example, Nifty represents top 50 companies traded on National Stock Exchange, which is NSE. And these 50 companies are the largest and most liquid companies available in the market. So just by investing in Nifty index fund, you are capturing about 50% of the market. And generally, whenever we talk about markets, we generally talk about Nifty, Sensex, these kind of indices, because these indices represents the overall market as a whole. But apart from these market cap based index, one can choose to invest in some sector funds or thematic funds.
Mm.
So, for example, by investing in Nifty based ETF or index fund, you can capture the essence of banking or financial services companies. Similarly, if you are bullish on certain other themes or certain other indices such as IT, or if you are bullish on consumption, then probably you can look to invest in these thematic or sector indices. In last few years, new types of indices have emerged in a big way. These are called factor-based smart beta strategies,
Mm.
and these indices are created basis certain performance factors. So the smart beta indices are nothing but they are trying to exploit certain performance factors in order to get desired results. For example, momentum based index, typically momentum has worked exceedingly well in India, because India being a trend market or trending market, trending stocks have performed exceedingly well, and this is one of the best performing smart beta strategy in India in last 15 years or so. And similarly, if a particular investor is slightly conservative, or if he is slightly conservative in an approach or risk covers, in that case, that kind of investor could start with low volatility kind of indexes, because low volatile companies generally protect the downside during tough market environment. So slightly conservative investors can start with low volatility kind of indexes. So there are various smart beta strategies based on either fundamental factors such as growth, quality, value, or it could be basis market oriented factors such as low volatility or momentum kind of index. So, basis the investment objective and risk appetite of the investor, one can also invest in these smart beta strategies. So, there are market cap based indices such as Nifty Sensex, then we have thematic and sector indices, and then we have smart beta vector based indices.
Wonderful. I'm not going to leave you today because you have opened up such a huge range of discussion for today. In fact, I would like to ask our audience also, if you have got any questions, please feel free. Go ahead, type your question in the chat box, and Mr. Shravan would love to answer these questions. Shravan, again, we talked about market cap based. Then we talked about thematic. We talked about sectors. Then we come to smart beta factor. We'll come one by one. Now, again, coming to market cap based, small cap, mid cap. We talked about large cap. See, when we know that small cap, mid caps, they tend to give a higher return. So, how to go about passive investing in those small cap and mid cap, funds? Is there any way to choose? How to choose? And can you guide us on that? Because many people are interested in small cap, And second thing, what is the best way to invest in a small cap fund? Why, active investing in the small cap fund versus passive investing in a small cap fund? Is there any way to compare like that? Over to you, Mr. Shravan.
Sure,
Yeah,
sure. In between, there were some network
I
issues.
think it's a long.
See,
Yeah,
no, that's fine.
yeah. Go ahead.
So typically, first time investor or new investor should start with broad market cap based index such as Nifty, Sensex, or Nifty Next 50, because these are large cap indices and these
Mhm.
are time tested uh, indices which are in existence for 30, 40 years. And these are large cap oriented indices, right? And typically, these indices are
Stability.
much more liquid, at the same time much more stable. So bulk of the investment should be in these market cap based indices such as Nifty, Sensex, or Nifty Next 50, right? Apart from these market cap based index, if a particular investor is bullish on certain themes, or certain themes attract that particular investor, then investor can choose to invest in some sector or thematic indices, right? And generally, we have seen these smart beta indices are also becoming very popular in India. And whenever you believe that certain themes or certain segment of the market could do well, you can choose to invest in these smart beta strategies as well. You refer to mid cap and small cap index fund, and you also refer to active investing. We believe that there are a lot of alpha generation ability in mid and small cap space. So one can combine large cap, probably could be either index fund or particular thematic based large cap active funds, and then one can combine active and passive both funds, because we believe that it's active and passive approach which will do better for investors rather than just picking up one over another. So we believe that there are a lot of generation ability for active funds, especially in mid and small cap space. So one should
Hmm.
construct the portfolio of an investor basis what works for an investor. So one could have a index fund on large cap side, then one can choose certain thematic or sectoral indices, and then probably one can have actively managed mid and small cap space, because we believe that there are a lot of opportunities available for active managers to generate alpha, especially in mid and small cap space.
Okay. So any team that you think that going to play out in next few years, that you love, you like,
See,
broader team?
currently we believe that, so from broader theme perspective, we are positive on banking sector, because we believe that the health of Indian banks is much more stronger as compared to most of the developed countries' banks. And from one sector perspective, this is very attractive sector at this point in time. Another sector is healthcare sector, because there are a lot of opportunities in healthcare space. The penetration of healthcare in India is nowhere near most of the developed countries. So these are broad sectoral themes one can play, and I am very positive on momentum as a strategy as well. So
Hmm.
because momentum as a strategy has worked very well in India in last 15 years or so. In fact, among various smart beta strategies, it is one of the best performing smart beta strategies. It has delivered close to 18% returns from 2005, because index these smart beta indices are available from 2005 onwards. So in last almost 18 years, it has delivered 18% annualized returns. And this is one of the best performing strategy along with quality and low vol strategy. So I believe that one can have combination of multiple smart beta strategies rather than just focusing on a particular smart beta strategies. One can combine momentum with low vol, because these are two complementary strategies, because momentum generally works well
Hmm.
uh, during trending market, while whenever market trends are changing quite frequently, typically low vol strategy protect the downside. So one can combine multiple strategies and then construct the portfolio.
In fact, my question was about to be that only. When you say that you love momentum, so are you kind of expecting that market breaking out in time to come?
So typically, momentum as a strategy works well during market expansion and at the same
Yes.
time initial slowdown, while it generally underperforms during recessionary pressure. In India, we have seen that markets are much more trending as compared to global markets, because as a
Hmm.
country we haven't seen many recessions, which is typically a time period wherein momentum strategy may underperform. So that is the reason I believe that momentum, and currently momentum is not aggressively tilted towards either quality or value. And generally, we have seen that momentum is a strategy which is agnostic to any particular investment style. So whenever, and it will pick up style which is in favor. For example, quality versus value mix keep changing every now and then, every 2 3 years. So
Hmm.
before COVID, we have seen that from 2016-17 onwards, from for about 3 years period, quality as in style was doing much better as compared to value style. And post COVID, we have seen that value started performing well. So momentum was having high exposure towards quality companies till 2020, and after initial good performance of value, it started riding on value as a theme. So it's agnostic to any particular investment style, and because of this style agnostic approach, momentum strategy may not underperform for elongated period of time unless market starts exhibiting short-term cycles. So because of this
Okay.
approach, we believe that uh, this could be a strategy wherein investors who are looking for long-term wealth creation probably can have some allocation to this kind of strategy.
Okay. Okay. Now again, okay. So one of the very important aspect from investment point of view is investing across different asset classes. Asset class diversification. So one of the very important asset class is gold. Okay. So now, anyway, I think you will agree with me that investors, at least some portion or the other, should be devoted towards investing in gold also, whether it's an ETF or something. So how, what kind of what kind of passive investing strategies or passive investing instruments are there for the other asset classes apart from equity?
Sure. Neeraj, you have alluded to the right, in the sense, approach for investors, because asset
Yeah.
allocation plays far bigger role in long-term wealth creation rather than individual stock selection or individual scheme selection. So investors should all at all point in time should maintain their asset allocation depending upon their investment objective and their risk appetite. And typically, we have seen that there is negative correlation of equity vis-a-vis gold or precious metals, because these precious metals such as gold and silver act as a hedge against market turmoil. And whenever we have seen that markets are going through tough time, gold as an asset class has protected the downside, and then because it is having negative correlation as compared to equity. And generally, we have seen that long-term equity is a long-term wealth creation asset class, but at the same time, it is a volatile asset class. To reduce the overall volatility of the portfolio, if you are combining assets which are complementing each other, for example, you should have equity, gold. Typically, as an Indian, we generally have a lot of exposure to real estate, but at the same time, we should have exposure towards these precious metals such as gold and silver, because they are having negative correlation to equity. And generally, whenever market is going through tough time, they are helping investors ride in the sense, or go through those volatile time period in a much more efficient manner, or your journey as an investor would be much more smoother if you are investing in different asset classes.
Correct. In fact, I would like to again request all our viewers कि अगर आपका पास कोई questions है, please feel free, go ahead and type your questions in the chat box. Now we have spoken about what are the opportunities, what are the different, thematic funds, smart beta funds, sectoral passive funds, even gold funds. Now we spoke about the advantages, any disadvantages, any risk that is associated with, passive funds. Maybe there are few.
Sure.
Yeah,
No, each and every product will have its own merit and demerit. So
demerits,
no product is, in a sense, one can say is
foolproof.
100% risk proof, foolproof or risk proof.
Yeah,
So see, major advantages of passive fund is it is available at low cost. At the same time, it is you are replicating the index, but active fund managers have the ability to generate alpha, and so spaces wherein the alpha generation ability is much more, such as large and mid cap and small cap, mid and small cap space, probably you can combine passive with active. So it's not that
correct,
passive funds will provide you complete bouquet of product. You should, as an investor, you should combine various funds from active and passive space.
Hmm.
So rather than just approaching active versus passive, you should combine various funds, which is providing you good diversification benefit. At the same time, your overall basket of products is complete. So, for example, the the core part of your portfolio could be broad market cap based index funds such as Nifty
Hmm.
Sensex, and then probably you can have some thematic or mid and small cap oriented funds from active space, and then you should have some allocation to gold and silver as an hedge against inflation. At the same time, whenever market is going through a difficult phase, at that time those products will save or protect you from the volatility of the equity markets. So, rather than showing the disadvantage, I would like to mention that there are few challenges why passive funds have not grown in a big way in India. First and foremost, these are low cost products. So, which means uh, uh, entire value chain from manufacturer like AMCs, distributors. So there is the commission or profitability is much lesser as compared to active funds. So the incentive to market these funds is much lesser as compared to active funds. Second, in case of ETF,
Hmm.
because large part of the trades are directly flowing through AMCs, so the institutional investors are allowed to invest directly through AMCs, which means that secondary market liquidity of ETF has not grown in a big way. So, which means that whenever you are investing in any ETF, the impact cost could be higher as compared to investment in index fund. So, probably to save that impact cost, you can choose to invest in index fund, because broadly, from overall portfolio constructs perspective, both ETF and index funds are very similar to each other. So, these are some of the challenges of investing in passive funds at this point in time.
Okay, okay, okay. Now there are quite a few funds following the same index, and also the same indexes having ETFs funds. So as you said, differentiators are broadly, the liquidity. Anything else apart from liquidity? Any differentiators? Why ETF or passive?
Right. See, From overall portfolio construct perspective, both are similar. So, wherein as a fund manager, my job is to replicate the benchmark. So, both
Mhm.
ETF and index fund are investing in underlying index securities in the same proportion. So, which means that fund manager is not taking any active call on any sector or any company. So, from broad portfolio perspective, both are same. The only difference is how you are investing. If you
Hmm.
are investing in ETF, then probably you need to invest through secondary market or the way we are buying or selling shares. So these ETFs are traded on exchanges. So you need to buy or sell these ETFs through secondary market. So which is BSE and NSE platforms, the way you are buying stocks. So you can take advantage of intraday price volatility whenever you want to invest in ETFs. So that particular
Hmm.
option is not available in case of index fund. But at the same time, because secondary market liquidity has not improved meaningfully for ETFs in India, mainly because institutional investors are directly investing through AMCs. So the impact cost could be higher. At the same time, you need to bear the cost of execution as well. For example, you need to pay brokerage, STT, or these costs that you have to bear as whenever you are investing in ETF. While these costs are bundled in case of index fund. So typically, investors who are having demat and trading account can choose to invest in ETF, but investors who are typically investing in any other mutual fund schemes, they can invest in index fund because investment in index fund is just like investment in any other mutual fund schemes, the way you are investing in any active funds.
Correct.
So these are
Okay.
two same products, but the way you are investing is
Hmm.
slightly different.
Slightly different. Okay. And now, very quickly, like ideally, what's a normal investors like me, a retail investors, how much of my portfolio should be to passive investing in terms of percentage, 20, 30%? You said it should be in a core portfolio. Basically, broad based kind of a Nifty or Sensex should be there, part of my core portfolio. So, in that core portfolio, how much percentage should be devoted to passive, and how much we can devote to active, in a broad number?
Sure. See, it depends upon the investor's investment objective. So typically, a risk-averse investor would like to have higher exposure to large caps. So in that case, probably that particular investor could start investing in broad market cap based index such as Nifty and Sensex. So which could be the core part of the portfolio. So typically, Nifty represents 50% of all the listed companies in terms of market cap, right? So probably one can have exposure towards Nifty broadly in the similar lines because it represents top 50 companies are 50% of market cap of all listed companies in India. So probably broad investor could have similar exposure to its Nifty or Sensex kind of indices. And then if you believe that certain smart beta strategies or certain thematic sectors thematic strategy on passive or active side could add value to your portfolio, you can add certain theme or smart beta strategies, which could be 10, 20, 25% of your exposure. And then probably you can invest in mid and small cap or flexi cap kind of active funds, which are agnostic to, flexi cap funds are agnostic to a particular segment of the market, which is large, mid, and small cap, because they invest across large and mid and small cap side.
Correct.
And then probably you can have one mid and small cap exposure, preferably on active side, because mid and small cap funds have generated alpha uh, in the longest time. So that's how you can construct your portfolio, and then probably you should have some exposure to gold and silver as an hedge against equity market
Okay.
volatility.
Right. Now let's take our discussion to smart beta, and now it is a very favorite topic. uh, so you talked about different strategies, momentum strategies, value strategies, and then and two three more strategies you have spoken. So can you take us a little bit more in details if somebody is very new to smart beta, for example, like me? So can you just, for example, you talked about momentum is likely to play out, so again, value. So what exactly is that, how the stocks are being selected in that particular fund, and how situation, what are the advantage, disadvantage, how they are likely to perform? Can you take us through those different type of smart beta funds?
Right, sure. So smart beta is a strategy wherein
Yeah.
so these are enhanced index strategy wherein just to exploit certain performance factors which have performed exceedingly well based on long period data analysis, these strategies
Hmm.
are created. So, for example, typical smart beta strategies which are very popular globally are quality, growth,
Mm,
value. So these three are based on fundamental factors because
mm,
some of the investors are inclined towards quality. So they believe that
mm.
quality as a segment of the market could perform exceedingly well. At the same time, this segment of the market could deliver consistent performance over long period of time. Then there are investors who are value focused, probably people who follow Warren Buffett, and they believe that if I'm buying stocks below intrinsic value, then probably I have greater chance of generating alpha in the longest time. Although the volatility of value segment is slightly higher as compared to quality as a style. Then we have market-oriented factors such as momentum or low volatility. So these are the smart beta strategies which are created basis market factors or price factors. So for example, momentum. Momentum is based on the hypothesis that recent market trends will persist over medium to longer term. And if you are buying winners and selling losers, in that case, in the long period of time, you are having better ability to generate alpha. So probably we can refer to slide 6 and 7, and then probably we'll get some sense about momentum and other smart beta strategies.
Okay. So there could be a combination of different strategies also in a fund, like growth, quality, and value together in one fund, and right.
Yes.
Yeah. Now, when you say
Sorry,
the
go ahead.
momentum, yeah, when you say momentum, now definitely they tend to get into momentum. They tend to give us a better return when the market is in a very trending market. Is there any risk, like suppose suddenly something market turn negative? There's a trend reversal, or there is some kind of event happens. So at that point of time, is there the higher risk associated with this kind of strategies?
Yes. If we can refer to slide number 6 or 7, otherwise,
Yeah.
wherein I will show you the performance of, right. So let me broadly give you the overview of momentum. What is
Hmm.
momentum strategies all about? So momentum is trend investing. It's based on the objective that market trends will persist over medium to longer term, and it's a buy high and sell high strategy or buy high and sell
Yeah.
high approach. Yes, it is buying stocks after initial rally. So, for example, UTI Nifty 200 Momentum 30 Index Fund is buying stocks which are performing well over last 6 month and 1 year period, based on the hypothesis that these market trends will persist over medium to long term, and these stocks which have performed well in recent past will continue to perform well going forward. And as I referred earlier, momentum is agnostic to any other factor strategy. So which means
Hmm.
whichever style is in favor, it will invest a high proportion in that style. So from 2017 to 2020, pre-COVID period, quality as a segment of the market was performing exceedingly well. So at that point in
Right.
time, momentum strategy has invested about 80% in this segment of the market. But thereafter, during COVID, value which was trading at deep discount as compared to quality style has started performing well. And last 3 years, we have seen that value is doing much better as compared to quality. So momentum strategy will pick up style whichever style is in favor, and then try to ride on the momentum of that particular style. So it's agnostic to any particular investment style, and because of this style agnostic approach, momentum strategy may not underperform over elongated period of time. Generally, we have seen that these style changes happens once in 2, 3, 4 years. So after initial rally of these styles, momentum will pick up that style. In fact, the father of efficient market hypothesis, Mr. Fama, he has mentioned that momentum is an exception to efficient market hypothesis. And because of that, he has mentioned momentum as a premier anomaly to efficient market hypothesis.
Hmm.
Next slide, please. Right. Here we have seen performance of various style analysis or style indices from 1st April 2005 onwards, because these smart beta strategies are launched by NSE from 2005 onwards. And we have seen that this blue line, which is showing performance of momentum, it has delivered 18.8% returns with 23.9% standard deviation in last 18 years, followed by quality and low volatility strategies, and then value, which has delivered slightly better than Nifty 200 index. So different market environment, different styles will perform. Probably we can move to next slide. Right. Here we have shown performance of various styles in different market environment. As you can see that from 2005 to 2008, before global
Mhm.
financial crisis, momentum was performing very well because at that point in time we have witnessed that uh, high beta stocks were doing much better. At that time, momentum was the market was trending or market was in expansion phase. So from 2005 to 2008 period, momentum has performed exceedingly well. Then we have seen during global financial crisis, various styles have corrected, but momentum may have corrected slightly more. But during recovery, momentum strategy has underperformed. Generally, momentum strategy hates frequent trend changes, and generally we have seen that whenever market is either falling and then recovering very fast in a very short period of time, or typically V-shaped kind of recovery, at that time momentum strategy underperforms. And thereafter, we have seen that momentum strategy has done fairly well as compared to other style analysis. So different styles will perform differently in different market environment. For example, low volatility and quality strategy generally protect the downside during tough market environment. So during COVID and during global financial crisis in 2008 and 9, we have seen that low vol strategy has corrected much lesser as compared to broad market cap crisis. At the same time, quality of segment has also corrected much lesser. So different asset different styles are meant for different market environment. So because of these reasons, one can have combination of various styles so that the volatility of overall portfolio could be minimized in an investor's portfolio. So rather than just riding on one sector, one style, investors should form a strategy or form a portfolio which the combination of multiple styles which are complementing each other. So for example, momentum is aggressive investment
Mhm.
strategy while low volatility is slightly defensive and it protects the downside during tough market environment. So one can combine momentum and low volatility in different proportion depending upon risk appetite of the investor.
Correct. Okay. So again, that's wonderful. You have really, really explained the whole concept very, very nice way. I'm sure the viewers can really now have some actionable strategy in their hand, right? They now know what they need to do in terms of their, uh, um, the factor investing strategies. Now, is it possible to invest in sectorial fund as well, sectorial specific sector through smart beta? Or particular
Yes.
theme?
Right. Yes. Along with market cap based and smart beta strategies, where various thematic and sectoral indices are also available, and there are funds which are offering these sectoral indices. For example, we at UTI are offering uh, UTI banking ETF. At the same time, we are planning IT ETF, which we are planning in next couple of months.
Yes.
So one can have combination of various sectoral strategies depending upon the view of the market. So one, there are a lot of sectoral ETF and index funds available in the market, wherein
Okay.
depending upon view of the market, one can invest.
Now you said about IT sector, right? And if you look at the IT sectors, actually, they have corrected a lot in last 1 year or something. They have corrected. So, do you expect any kind of recovery in the coming days, or something like pharma sector as well? We talk about. So, any few sectors that you can talk about where we can look for sectorial investing?
See, IT sector, because about two-thirds of IT sector revenue comes from US and Europe, because India, IT being a very big service sector export oriented industry, wherein bulk of the money is coming from US. And since there are high probability that US is heading towards recession, because of that reason, IT sector has underperformed in last few months, mainly because typically whenever uh, developed market feel that the environment is tough, then probably they can resort to cut IT spending budget. So because of which IT sector has gone through tough time. But from quality perspective, IT is a sector which is quality oriented sector, because Indian IT companies are uh, especially large IT companies are in the sense are having very strong foundation. They are generating huge amount of free cash flow and operating cash flow. So which means that quality of the Indian IT companies is much more stable as compared to various other IT companies that we have seen globally. So because of this, we believe that IT companies are one of the big wealth creator for investors in the longest time. At the same time, I mentioned healthcare because typically healthcare is a sector which is in India as an Indian. generally the spending on healthcare is much lesser as compared to developed countries. So because of which we believe that there are a lot of penetration story available in healthcare space, because the healthcare penetration is much less in India, and we have long way to go uh, uh, to take care of our health. So we believe that the healthcare sector is also offering long-term growth potential for us.
Wonderful. Wonderful. Okay, now let's talk about the tax part. Now, do you think like are the passive funds kind of tax efficient than the active funds? How is the tax treatment?
See, taxation of any fund, or be it direct equity through active funds or passive funds, it is basis time horizon of investment. So, any investor who is either buying stocks, direct stocks, active funds, or passive equity funds, if your time horizon is less than 1 year, if you are selling within 1 year, then you have to pay short term capital gain, which is 15% in India. And if you are investing for more than 1 year, then at the time of profit booking or at the time of selling, you have to pay long term capital gain tax. Same for direct stocks, active funds, and passive equity funds, which is 10%. While on debt side of the portfolio, whenever you are investing in debt, active funds, or passive funds, the taxation is linked to your marginal tax rate, depending upon your income levels.
Okay, it
So
might
there is
sound
no
yeah.
differentiation between active and passive.
There is no differentiation between active and passive. It's whether short term or a long term
Short term and long term, and then asset class.
and
Equity
asset
is
class.
favorably taxed. No, right.
Correct, correct. Whether it's a debt, gold, or equity. Now, again, it might sound a bit novice. Like, okay, I want for tax planning purpose, ELSS is something that I always look for, right? Can I invest in smart beta or smart beta finds through ELSS or something? Is there any way that I can take advantage of? There's a 3 years lock-in period that I can take advantage of, high growth in my portfolio, and at the same time I can take advantage of some tax benefits. Is there any way to do that?
Right. So that 80 under section 80C, only ELSS schemes within
Yeah.
mutual fund schemes are getting that tax advantage or tax treatment, which is favorable as compared to any other mutual fund scheme. So to take advantage of Income Tax Act under 86 under section 80C, you have to invest in ELSS, either active or passively managed ELSS schemes.
Hmm. Is there any ETF
While
under that? Okay, passive funds, active or
they are
passive.
not.
Then okay, great. So I think we are almost coming to an end of this program. Anything that I have missed? So you are an authority in the subject. You have been managing so many different funds. The kind of experience that you have, the kind of depth that you have got, I may not be asking some right questions also during the discussions. So Shravan, it's absolutely up to you. If you think that I have missed something very important which I should have asked, would you like to tell our viewers?
Sure. So I would advise investors to approach equity markets from longer term perspective. So rather than timing the market, whether I should invest today, whether I should invest after some correction, one should approach equity markets from longer term perspective, because equity markets have been one of the best wealth creator in the long term, because Sensex was launched in 1979, and in 44-year long journey, it has generated 16% annualized returns year after year in 14 years of long period. So one should approach investment primarily from asset allocation perspective, and depending upon the investment objective and risk appetite of the investor, one should invest in equity funds basis SIP approach, because I would say SIP is the eighth wonder of the world, because by investing in SIP, you don't have to take a call on market levels, because every month end you are investing some amount out of your savings into equities, which will compound over long term. So we believe that rather than timing the market, time in the market is more important. So one should approach equity as an asset class from longer term perspective, and whenever markets are going through tough time, probably you can increase allocation towards equity, because typically valuation should be the guiding principle for investment in equities, because equity as an asset class has tendency to revert back to mean valuations. So rather than being fearful during tough time, and getting too greedy during market highs. One should continue to invest in equity markets at different point in time to get rupee cost of average cost of investing, and uh, equity will deliver phenomenal results, because generally equity and asset class generally generates returns which is very close to nominal GDP growth rate. So probably one can expect low double digit kind of returns whenever you are investing in equity as an asset class from longer term perspective, because real GDP is growing 5, 6, 7%. At the same time, 4 to 6% inflation is there. So which means that nominal GDP is 10 to 12% that we can expect in next 5, 10, 20 years. At the same time, because Indian economy is not completely formal sector, right? So the bulk of the Indian economy uh, is based on the informal segment of the market. So which means that the large companies which have generated huge amount of wealth, at the same time they have created infrastructure, they will continue to grow higher than informal economy. So which means that probably one can expect slightly more than nominal GDP kind of returns from equity as an asset class. And one should always follow asset allocation. One should have balanced portfolio which comprise of equity, debt, and some bit in gold and silver to protect the downside during tough market environment.
Wonderful. I think great. We discussed about a very new strategy called smart beta passive, and then we talked about asset allocation, and you talked about how to build a core portfolio. What should be the weightage of all different kind of instruments in the portfolio. I think it's a great session, Mr. Shravan. Nice talking to you. Thank you so much. In fact, looking forward for many more sessions so that we can learn and more and more things from you. And with that, like to thank all of you, all the viewers, and thank you so much, Mr. Shravan. Thank you.
Thank you, Neeraj. Thank you so much.
Thank you.